Mokama Sunday service. This is a channel that is primarily focused on trade execution and just learning trading, specifically for beginners. This is not financial advice. I am not a licensed financial professional. You should refer all of your trades and investments and consult with your licensed financial professional or advisor. And remember, trading is risky. There's risk associated with trading. So with that said, we're going to start. And today we're going to be talking about options, mistakes, and rules, and just kind of rules of thumb that I've created. And the list gets longer when I make mistakes. So hopefully you can learn through my mistakes and not do this when you're trading options if you decide to start trading options. So I'm going to share my screen. My wife told me the other day that I'm old because I still use the term PowerPoint.
Hey, that's just what we know it for. That's all it is.
Yeah, but now she said it's a slide presentation because no one uses PowerPoint anymore. So I'm like, whatever.
Uh, okay.
All right, so let me head
That
back
was the
there. All right, top 10 mistakes that will ruin your options trading. Number one, and we've talked about this relatively recently, is liquidity. Is the option liquid? Is there enough open interest to buy and sell that option? Right? So let me go to Think or Swim, which is the platform that we typically use, right? So let's go with an ETF that I know is typically always liquid because it's traded consistently, and that would be SPY or something like QQQ. You go to the trade tab, and let's go to the nearest expiring option, which is on Monday, on June 3rd, right? Now, if you look at the open interest on the calls, it's 3,700, 4,000, 4,000, 8,700 people, or, willing to trade this option. That is relatively liquid, extremely liquid, I would even say, because SPY, this ETF, is traded consistently. Even on the put side, you'll see a little bit less open interest in the money, right? So actually, the puts, this is a good example because the puts that are in the money are relatively illiquid. And what I consider illiquid is anything like under 500, maybe even 1,000. Ideally, in an ideal world, there's 1,000 open interest, but I'm trying not to trade anything less than 500, and really anything less than 750, you're kind of pushing it, right? But if you see this 387, 249, 171, 273, you might have a good idea. SPY might be headed down, and we're talking about the put side if you're buying puts, but they're going to be relatively illiquid, which means it's going to be more difficult for you to get out of this trade. So with illiquid options, it can be easy to get in because somebody will sell it to you. But when it's time to get out, if your trade is profitable, like, can you get out? If your option has low open interest, it's going to be hard for you to get out, and you might miss your target because no one is willing to trade with you. So that is mistake number one, trading an option that is not liquid. So when people talk about liquidity and options, that's typically what they're talking about is the open interest. Now, if you go into Thinkorswim, when you first get there, this might be the default setting. Actually, it's usually not that. It might be one of these, right? This might be a default setting. If you want to make sure that the open interest is up on your chart, you can go to the volume open interest template, right? And then generally, I'm going to customize that even further. And I'm going to make sure that the percentage change is in, well, actually, not the percentage change. I'm going to make sure that the delta is in there, the theta is in there, right? And the last price. Those are the things that I usually want to see on my option chain, right? And so when you customize it like that, then you're going to see all of the things that you need to see. But you really want to make sure that the open interest is on your chart so that you're not like toggling this around when you're trying to trade at the same time, right? So that's extremely important. The next thing that's extremely important is the spread. Is the spread of the option too wide? And the spread is the difference between the bid and the ask price. This also kind of goes to liquidity as well. So going back to that same option chain, what we mean by spread is the difference between the bid and the ask. Here is 3 cents, right? You don't really want to see this get wider than 10% of the option price, right? So in this particular case right here, the option price if you're buying a call is $1.01. So we really don't want to see more than a 10-cent spread in these options that we're buying. And the same for the same reason is like, so ideally when you're buying an option, you can easily get in for the ask price. If you're willing to pay $1.01 for this, you're probably easily going to be able to get in. But your goal should be to try and buy this option closer to the bid, especially the last price that it was traded at. So 99 cents to $1 rather than that $1.01. This becomes even more important when the spread is wider than 3 cents, when it's 10 cents, 15 cents, something like that. But ideally, you don't want to be trading an option where the spread is more than 10% of the option price, right? So let me go see if I can find something that's relatively illiquid or where the spread is yeah. Oh, this is a perfect example. Look at XLI. The spread difference here is $4.88, right? So that means you could be buying this for $4.90 or $490, but the bid that people are willing to buy this for is only $2, right? So here's a perfect case. And then you'll also see that some of these kind of coincide. If the spread is this wide, chances are the open interest is really low too. So I might think XLI is going up. It's going to go up quickly, but I can't buy this option because the spread is too wide and the open interest is really low. So I probably would be better off buying the shares, which may be more expensive if I wanted to take advantage of XLI going up. Right. So this is a perfect case. Like I might,
Open interest meaning,
the amount of people willing to trade this option, there's only 47 people or 47
gotcha.
accounts, right? Versus this one up here, there's 1,000 people. So if I were to buy a call on XLI, I would not choose this strike price for the reason that the open interest is really low and the spread is $4.88, which means that you might be giving up $400 for every contract when you trade this because the spread is so wide versus this strike here at 122 and a half. This is a better option to buy, even though that the spread is really wide. I still wouldn't buy this option because the spread is 58 cents, which is more than 10% of $1.75. The open interest is better. There are more people interested in getting into this trade. It fits that qualification, but look at the spread, which means that if I buy this right now for 175 and then try to immediately sell it, it would be hard pressed for me to sell it immediately for 175. I would probably have to take a loss at 117, even if the ETF price is exactly the same. It's just because the spread is too wide. So that's also a liquidity issue in terms of getting in and out of a trade. So I might like what XLI is doing on that day or at that moment, but I wouldn't trade this with options because I'd be giving up potentially 50, $60 a contract just trying to get in and out of the damn trade, right? So that would be a mistake. Trading this option, even if I did have a good idea on this stock. Um, that's just kind of, and I'm on the call side. It also uh, would relate to the put side too, because this spread is huge right here, right? This spread is huge, $5 versus 35 cents. That's a huge spread versus when we looked at SPY, the spread is only 3 cents. So this is more of a liquid ETF. Usually the mega caps, like if we look at Tesla, the things that are traded all day, every day, are usually going to have smaller spreads. So Tesla's spread is 15 cents, but that's not that big when the option is $4.55. A 10% spread would be 45 cents here, and it's only 15 cents. So, and that makes sense because Tesla is usually extremely liquid. There's always a ton of people trading it. If you look at the open interest is usually huge on both sides, right? Because people are constantly trading Tesla up or down. So let's look at, let me just give one more example. What's something? QQQ is usually really liquid too, something that's traded extremely often. Actually, though, the ones that are expiring on Monday aren't. And then sometimes this is why when you're talking about picking your expiration date, here the expiration date is June 3rd. And you'll see the open interest is relatively low for the June 3rd contracts, with the exception of the one that's like right at the money, which is the 451 strike, right? And if you go out of the money, the open interest is low, but I never trade options out of the money because they're less likely to be profitable. I usually like to trade things in the money, which is this shaded area, and you'll see the open interest is relatively low in the money. So what you might want to do is go look at other expiration dates to see if the open interest is higher, and actually, the Qs don't look extremely liquid at all. That's interesting. That is really interesting. It looks like the most open interest in the money would be the June 7th, the ones that expire. I think that's a Friday. Uh, that would be the option that I would trade because the open interest is higher on these calls. So I wouldn't trade the June 3rd. I would trade the June 7th, right? And this is what I mean by like little mistakes. So we might have the same direction. We might both think that the Qs are going up on Monday, but I'm going to choose the June 7th because it's going to be easier for me to get in and out of this trade if I take the 450 calls because there's more open interest and the spread is also decent, right? It's less than 10% of the options cost. Here, even this strike right here, it's only 7 cents with a really high priced option where the max spread that we would be willing to trade this at would be around a 50-cent spread, and the spread's only 7 cents. So this is going to be an option that's going to be pretty liquid, and you shouldn't have any trouble getting in and out of this trade if things go wrong or if things go right. The next thing after spread, after the spread of an option, will be the price. Is the option too cheap or too expensive to scale? When I'm buying options, um, I typically want something that is priced at $1 to $5. And that's because of my account size that I trade with. If we go back to SPY and go back to the Monday options, right? So this would be around the price. Okay, it's not too cheap. And what do I mean by too cheap? Too cheap would be if I'm buying an option that's 13 cents. If that 13 cents doubles to 26 cents, you'd be like, wow, we doubled our money. Yes, and you would have to buy like 50 of these to really make a dent because $13, like if that doubles, okay, so you made $13. So how many of those would you have to trade to make like $1,000? 50, 100 of those, right? To try and make $1,000. And then you also got to remember that a lot of these platforms are charging you fees for trading options. So if you're trading these inexpensive options, you're going to need to see a 3x, 4x, 5x gain to offset some of the fees that the platforms are charging you to buy options. So that's why you don't want to buy an option that's too cheap. Ideally, you want to buy an option that's $1 or more, no less than like 95 cents. Um, and then also an option can be too expensive. Let me go show you NVIDIA. Right. NVIDIA's options are extremely expensive. It's going to cost you $2,800 to buy one contract of NVIDIA. And this is one of the reasons why they're probably doing a stock split. They're doing a 10 for 1 stock split soon. And so if they're doing a 10 for 1 stock split, at some point in time, this $2,880 option is probably going to be $288. And that's one of the reasons why companies do stock splits, because if your option prices are this high, if your stock price is $1,000, that's going to limit the amount of people who are going to be willing to buy and sell your stock or your options, because most people want to buy things that are $100, or Apple is under $200, right? So you could buy 5 shares of that versus 1 share of Nvidia. So a lot of companies are going to do a stock split so that more retail traders are interested in buying their stock and don't see it as expensive. Even though when a stock splits, it's essentially the same exact price. It's just adding more shares and divvying that up. So every person that has 1 share is going to get 10 shares of NVIDIA. But it's essentially going to be valued at the same exact price. It's just going to be divided by 10. So here, this is extremely expensive. I usually, when I'm trading options, I at least want to buy two. Um, in an ideal world, I'm buying 4 to 10. And the reason why I want to buy multiple options is because I want to be able to scale in or out of a trade. And when an option is when an option is 2,880 bucks, it's hard for you to buy more than one of those. And this expires on Monday. It would make sense for an option to be this price like this and have this high of a price if you were buying leaps that are 6 months to a year or a year and a half out. But for an option to be expiring on June 7th, on Friday of next week, this is extremely expensive. So most people are only going to be able to buy one of these. But I generally have a target one when I'm buying options, like a price that, hey, I'm going to take some profit off of the table and then keep a runner. Or if I'm buying 4 contracts, of SPY is a perfect example, right? So if my max trade amount is $800, or let's say $1,000, I can buy 10 of these. And so if I hit a shorter target, I might scale out and sell 5 of them. And I still have 5 runners left that I'm playing with that are like house money trades. I've already taken some profit off the table. I'm going to move my stop to break even. And then I'm essentially playing with house money on 5 runners. And then that stops you from going, damn, I should have held on to that trade for longer, or why did I sell my position? If you only bought one contract, then you can't hold on for longer. You got to sell your one contract when you hit your target and you're done. But ideally, you're buying 2 contracts, 4 contracts, 6 contracts, 10 contracts, right? If they're priced appropriate, like at $1, and then you can scale out. So if SPY goes on this huge run, you can be conservative with your first target and then sell half of your position and then just leave a runner and then keep a stop at break even. So where you're essentially just playing with house money. So if this thing wants to 10x, you can be in that trade without feeling that you're going to lose money or lose some of your profits. All right. Does that make sense, y'all? Y'all with me?
Makes sense. Yep,
Yeah.
makes perfect sense.
The next one is your expiration date. What is your time frame for the expected move? The shorter the time frame, the greater the time decay. Let's go back to think or swim. Okay, so let's say, so SPY is essentially an ETF for the S&P 500. Now, let's say, hey, I think SPY is going to go up over the next month. If and I really think that it might consolidate over the next month, but as we get into, let's say, July, I think it's gonna head up. Or as we get to the end of June, I think it's gonna turn around and then start really like coming back up for whatever reason. I don't know what reason that is. Maybe it's because somebody has earnings. The Fed is getting ready to cut. You think the Fed is going to cut interest rates in July or August or something like that? Whatever that reason is, your time frame is everything. So you need to give yourself some time for that move to happen. So if you're trading SPY with an expiration date of June 7th, you're not giving yourself enough time for that move to happen. So that's extremely important. If you're day trading, if you think, hey, this move is going to happen in the next 5 or 10 minutes because of some technicals or some indicators that you're using, then the shorter expiration periods might make sense for you. But if you're less sure of yourself, if you're not sure exactly when it's going to happen, or hey, this trade might take a couple of weeks, this trade might take a month, then you're going to want to go further out on your expiration date. And the thing about further expiration dates too is that the time decay is lower. And this is if you're buying options, not selling options, right? And you're selling options, I usually want a shorter expiration date because I get paid for time decay. So I want time to reduce the price of that option as much as possible. So I'm probably going to pick a sooner expiration date if I'm selling options. If I'm buying options, I don't want that time decay to go against me, especially if I think this is a longer term move. So I'm going to pick a further out expiration date so that the time doesn't reduce the price of the option as much. As the closer you get to expiration, the more theta affects the actual option price. So if you think that this trade is going to take a little bit longer to develop, if it's a swing, you might want to be 3 weeks to 4 weeks out on your options that you're buying. And if you think, hey, I'm selling options and I think this move is going to happen relatively quickly, if you're on the buy side, then you might want to be in the shorter term options, right? And what you'll see too is the options that expire further out are going to be more expensive, and the ones that are closer to expiring are going to be less expensive. But if you're buying, like you're going to see what the theta is. Look, that's 55 cents. So out of this $1.05 that you might buy this call, the time value included in there is 55 cents. That's a lot of time decay. So that means on Monday, this is an expiration date on Monday, you're going to need that move to happen quick. I mean, 30 minutes, an hour. Otherwise, this time decay is going to eat at this option all day long, right? If this move doesn't happen. Now let's look at the same strike. So we got a 528 strike with an expiration date of Monday, June 3rd. Let's look at that same strike on like June 21st. As you'll see, theta is only 16 cents right there, which means time decay is going to be affecting this option price, which is way more expensive at $592, but the time decay is way less because the option is further out. Does that make sense?
Yeah,
Right? So
yes, it does.
that's why.
Elaborate on that a little more.
So theta, this is why I include theta on my option chain, because this will tell you how much time decay, how much value of time decay is inside of this option right here. So as time passes, and I'm not sure, I have to look this up whether it's a daily basis or per dollar movement. As time passes, this is going to have a time decay of 16 cents or $16, right? That's included inside of this option price. As you get closer to expiration, that's going to be more pronounced. As you see here, the theta values are higher, which means they're going to eat at this lower option price more than if you went further out and had a longer expiration period for your option, right? And that's just a month or 3 weeks worth of time. If you go even further out, like let's go a year, theta is going to be even lower. And that's why leaps don't tend to decay as much as trading something that expires within a couple of weeks. So, and that's another benefit of trading leaps is that generally when you're buying options, one of my primary concerns with buying options is time decay, which is why I like to sell spreads because time decay is on my side when I sell spreads. So, if I have a shorter expiration period, I would more prefer to sell spreads directionally, whether I'm selling a call spread if I think the stock price is going to go down or I'm selling a put spread if I think the stock price is going to go up. But in both cases, I'm taking advantage of theta or time decay. But if I'm buying leaps, I'm not going to sell a spread on my leaps. What I will do though is I will buy a leap, I'll buy a call. Typically, I'm usually buying leaps to the upside. And I'm not as worried about time decay because the further you go out, the less theta affects this option. And you'll see the option is more expensive, but theta is only 6 cents or, out of 55 dollars and 41 cents. There's rarely there or there's not a lot of time decay priced into this option at this point in time, which is why I love leaps. Time decay doesn't really start affecting this option price until we get to about 3 months before expiration, and that's when I'm going to think about getting out of my leap trades if I haven't already sold, you know. But that's why leaps are so good because the most dangerous part about buying options, whether you're buying calls or if you're buying puts, is the time decay. So if time decay is really low, then it's less risky to buy this option versus time decay being extremely high, then you need this thing to happen fast if you're doing a zero DTE option, 0 days to expiration option, which would be SPY's option that expires on June 3rd, right? So if you want SPY to go up, or if you're thinking SPY needs to go up, like on Monday, you need that to happen in 5 to 15 minutes. You're probably day trading options because if you're holding this all day, like there's 55 cents of theta on that, you know, and you better hope that gets in the money real fast so that gets reduced to 15 cents. But if it doesn't, right, if this just goes sideways for 2 hours on Monday, you're going to lose money even though the price isn't moving up or down because of time decay. And that's the main issue with buying options is time decay. And this is for me. And so this was the reason why I started selling spreads is because I told myself, I say, hey, I always want to be on the other side of time decay, where if a move is taking forever, I want that to make me money, not lose me money. And so if you're selling an option, you take advantage of this 55 cents. If you're buying an option, this 55 cents is going to be against you, right? So your expiration date for that reason is extremely important, especially when you're buying options. It's because that time decay is going to be less the further out that you get. Trading around earnings and events. Are you trading options near or through earnings or a major event? So I wish we were in earnings season right now. We're kind of out of earnings season, so it's going to be hard for me to show you an example of this. But options become way more expensive as you get closer to earnings. And then there's something that's called IV crush or implied volatility crush, where right after the earnings are announced, the price of the option is going to drop. So, one rule that I typically have for options, unless I'm already profitable on that option and have been in that trade well before earnings, chances are I'm going to sell that option before earnings. Even if I'm selling spreads, I'm probably going to get out of that trade before the earnings reports. So if it reports in the afternoon, I'm probably going to sell that option before the market closes 4 p.m. Eastern, 1 p.m. PST, right? I'm going to get out. Now, I could be right, I could be wrong, but playing earnings is like a coin flip to me. So I don't want to be in this for 50-50 trades. Ideally, I have a strategy. So I'm not, bet. Then you could just go to the casino and then bet on black or red. So because I don't want to do that, usually I'm trying to get in, even if earnings, let's say, is on Friday. Let's say a company has earnings on Friday of this week, and I start my options trade on Monday. um, I'm probably going to get out by Thursday, or if it reports after the market closes on Friday, I'm going to get out before the market closes because earnings are extremely volatile events, and you just don't know how the market's going to react to earnings. As I've showed you in the past, sometimes a company could have good earnings, they could beat their estimates, and the stock price goes down. Sometimes a stock won't beat the estimates and miss on their estimates, and the stock price will go up. So I usually want to wait a day or two after earnings before I start trading that symbol again so that the stock price is kind of settled down and become more stable again. But you got to be careful trading through earnings or right before earnings, as well as events on that stock. So a lot of the tech stocks have earnings, or not earnings conferences, but they'll have tech conferences. NVIDIA will have a tech conference. Google will have a tech conference. Michael and Apple, or not Michael, Microsoft and Apple will have tech conferences and events and annual events. And be careful trading when those events are happens, because what I've been seeing is that the stock will rise before the event and then will sell off as soon as the event happens. So what they say, buy the rumor and sell the news, and that's what's typically happening. So if you see or pay attention to something that you're trading, if there's going to be some sort of major event on that stock, they're announcing some new product. If Apple is announcing the Vision Pro, typically what will happen is the stock price will run into the earnings event and then sell off. So you kind of want to be out before the event is announced, unless you're already profitable on that trade and you got your stop set, you know. Um, so be careful with earnings and events. Dividends. It's kind of like an event on a stock, same thing. If a stock is getting ready to issue a dividend, a lot of people will like to buy that stock up before the dividend is issued, get that dividend, and then they're going to sell. So it's just kind of one of these things on a calendar that you need to pay attention to for a particular stock is, hey, when is the dividend date? So just to kind of show you that on Thinkorswim, where is it? Market Watch, calendar. Let's go. Who does dividends? Home Depot. Something I've been watching since Isaac.
Costco too, right?
Huh?
Costco also, right?
Yeah. Let's use Costco because they just reported earnings. Stock dropped after they reported earnings, right? So here was the earnings date right there. Let's go. Oh, July. Nope. August. And the dividend will be the money sign right here. August, September. Wait, does Costco give dividends? October, November. I don't know. Let me just try Home Depot. Home Depot dividend date was, is this June or May? That was May. So let's go 3 months. September, October. When is the dividend date? Oh, maybe they haven't announced it. Let's go back in time, man. So Home Depot, they announced their dividend on May 30th, right? So chances are, and I'm not gonna go back and look and see if it's sold off. But actually, let's look at that. Let's see if on May 30th or 29th it sold off right before the dividend. What was the date of the dividend again? It was no, it was May 30th. No, this is a date it actually didn't sell off on dividend date. I stand corrected. But just be careful. I've just noticed a lot of stocks, if they're issuing dividends, you're going to see some sort of sell off. So it's just something to be wary of. Like keep your stops tighter. Don't take as much size if you know it's getting ready to issue a dividend. That's usually a good selling opportunity for people to get their dividend, make sure they collect that income, and then they might think about selling that stock at that particular time. HD probably didn't do that because it was already sold off, right? So but especially if the stock is rising and is really high, let's say if HD was up here and then issued a dividend, don't be shocked if people collect that dividend and then the next day they sell off, right? So just something to watch, but you can go to the calendar and then whenever they have a dividend issue date or it gets reported, it'll be there with this dollar sign. And so it's just something to maybe note if you're trading options on this particular stock close to that expiration date. Or let's say your expiration date is sometime in June and you bought that option sometime in the middle of May. Like you might want to be wary about your the dividend date on HD. All right. FOMC, the Fed. Are you trading options near a Fed decision on rate cuts or hikes? And are there any Fed speakers or minutes or releases? This has been the biggest thing lately in terms of the things that have been pushing the market up or down. Will be when Jerome Powell comes and speaks. And then he'll say, "Hey, we think we're cutting rates soon." And then we get some inflation data. And then he says, "You know what? Maybe rates are going to stay higher for longer." And then one of the Fed governors that isn't Jerome Powell will come in and say, "Hey, I think we should even be thinking about hiking rates." And when all of these things are happening, typically the market will react if they say something that's not within the line of the status quo. So anytime Jerome Powell speaks, I'm going to tighten my stops, or I might not even trade until his speech is over. So to kind of look for, and I've been showing you like to look for these things would be going to just going online and see, can I get another window up? No, let me exit out of this, go online. I usually type in stock market catalyst, go to the US economic calendar, and you'll usually see for the week what's happening. Are there any Fed speakers? Um, this week, there aren't any Fed speakers, but I feel like last week was ridiculous. Yeah, last week you had a Fed speaker on Tuesday, two Fed speakers on, no, three, four, I'm sorry, five Fed speakers on Tuesday last week. Then you had one on Wednesday, um, you had a couple on Thursday. And so those are just usually things that can push the market one way or another if somebody says something weird or off brand from what Jerome Powell stated. So I've been looking at the market a lot when these Fed governors or when the Fed chair has been speaking, and you can literally see the market reaction if you're looking at the S&P 500 or the Nasdaq or the Dow when they speak, when they say certain things. So just be careful if you see that a Fed chair, especially if it's Jerome Powell. Jerome Powell will move the market. So uh, get out of your trade. Don't get into a trade right before he speaks or keep your stops extremely tight if you're in a trade while he speaks. And related to the Fed is inflation numbers. You'll usually see these CPI, PCE, and PPI. PCE is the number that the Fed likes to watch the most, but generally you can get a gauge on what PCE is going to be based upon the CPI readings and the PPI readings. If the CPI and PPI readings are really hot, then chances are the PCE is going to be hot too. If CPI and PPI are cold and inflation is cooling, chances are PCE is going to be cold too. But Are you trading options near inflation data releases? If you are, that's going to be a big area of volatility. So if you see CPI, PCE, or PPI is coming out the next day, and these numbers usually get released at 5:30, and with options you can't trade them after hours. So if you see you're trading options, you have a position on, and CPI is coming out on Thursday, you might want to consider trimming your position, getting out of the trade on Wednesday. Otherwise, you might be subject to a gap up or a gap down on your particular trade when CPI or PCE or PPI comes out at 5:30 in the morning, or PST, an hour before our market opens. So just be very wary of these, um, and keep your stops tighter. If you've already profited and, let's say, exited half of your position, you might want to keep your stops tighter around these particular these days, because right now, um, we're all looking towards inflation to determine whether or not the Fed is going to lower interest rates, or keep them the same or hike them. And the weaker or the cooler the inflation data is, then there's a greater chance that the Fed is going to start lowering interest rates. If the Fed lowers interest rates, that's going to be good for stocks, equities, and the stock market in general, because cash is going to be easier to obtain at lower interest rates. So it's going to be easier for companies to grow. If the CPI is hot, then the Fed is going to keep rates up for longer, because that's what they've been telling us they're going to do. And if rates are higher for longer, and you got a couple of houses, it's the real estate market's been trash lately because nobody wants to move, nobody wants to sell their house because they're locked into these 3-4% mortgages. You probably got one or two.
Hmm.
Yep. So
Yeah.
it's been trash. So everyone is waiting for rates to come down. If rates don't come down, the real estate market is going to be trash. A lot of these growth tech companies are going to be trash because they can't borrow money, or they got to borrow money at extremely high rates, which means they can't grow. Um, so everyone's looking at this in addition to jobs data. If we get a lot of bad jobs data, then that's another reason why the Fed might lower interest rates, because they have a two-part mandate. Their first mandate is to keep inflation down. Their second mandate is to try and keep us close to full employment. So if one of those two things slips, it's going to affect their decision regarding rates. So if inflation stays high and jobs are, we have a really booming job market, then rates are going to stay higher for longer. If jobs start coming down and unemployment rises and inflation comes down, then we're going to see the Fed cut rates a little bit sooner, which is going to stimulate more economic activity, which is going to be good for the stock market and the housing market too, depending on which side you're on. If you're buying, prices are probably going to keep going up, unfortunately. But if you're selling or you own a house or some property, your property values are probably going to kick up a little bit more if they start lowering interest rates, because then more buyers are going to enter into the market. Um, the next one that's killed me, and these last few are the ones that have killed me and have hurt some of my months, where I was positive for the month and then I became a cowboy on the third Friday. I hate Fridays and I hate end of the month, right? Third Fridays is when a lot of options are expiring. So you have the more liquid ETFs, or the more liquid stocks that might have zero DTE options, which means they have options that expire every day. And then you're going to have some stocks that only have options that you can trade on a weekly basis. And then you're going to have stocks that you can only trade or that expire on a monthly basis. For those stocks that expire on a monthly basis, they're going to expire on the third Friday of every month. So sometimes you can have a volatile session on the third Friday, not because of some news or because a stock is doing this or that or technicals. It could just be people are adjusting their positions because they have expiring options coming up. They're rolling things over into the next options expiration date. So they might be selling or buying for reasons that have nothing to do with news or the stock itself. They could just be adjusting their portfolio. So the third Friday of every month, you're going to have options expiring on a lot of stocks, futures contracts, etc. So that's a very volatile session. So you might want to keep your stops tight, not trade so much size on the third Friday of every month, but do things that, like if you're going to trade at all, trade smaller size. Don't go for the don't go gung ho on a third Friday, because things could be going up and down. It could be choppy for reasons that have nothing to do with the stock price itself or the company or any news that's been released. And coinciding with that is the last one that I got screwed with a day ago, was the end of the month. For the same reason, if you're trading options on or through the end of the month, remember, a lot of hedge funds, a lot of people who are dollar cost averaging into stocks or buying and selling, they do it at the beginning and the end of every single month. So they're reorganizing their portfolio. They're taking profits on certain things that have done well for them that month because it's the end of the month. A lot of trading strategies, specifically one that I follow called the Strat, has to do with candles closing on a monthly basis or a quarterly basis. So people are really assessing their positions at the end of the month and could be selling things off just to adjust their portfolio. Or a lot of hedge funds and 401ks and things of that nature are putting money in on the first. So the end of the month is very volatile. So that's why be careful if you're trading at the end of the month, beginning of the month as well. But specifically at the end of the month, you are subject to see a sell-off. And like we did on Friday, there was a sell-off that eventually turned around, and I got caught up breaking one of my rules, taking too much size on a trade, and ruined my month. I was up for the month, and then ended up being at near break even because of one trade on Friday. So this is my newest rule: is be very careful at the end of the month, take less risk on the end of the month. I should have took that position that I took on Friday on one of my day trades at probably a quarter of the size that I took it at. Um, but yeah, that's you live and you learn. But ideally you can learn without losing too much money. My long-term positions are doing really well right now, especially those leaps that I gave y'all last week. But my day trading has been crap, and it's because I've been breaking some of my rules. So this exercise is also an exercise for me of having rules so that I can kind of check off these boxes before I'm trading. So if I see it's the third Friday, I'm going to check for that now. If we're close to the end of the month, I'm going to check for that now. And I already, the ones that were at the beginning, I don't usually enter a trade, even though I think it's good, if I haven't checked the spread, the price, the expiration date, the open interest, things of that nature, just to see, hey, is this a viable trade? Or is there going to be some technical issue that could potentially lose me money, even if the stock price goes in the direction that I want it to go? Right. And when you're trading options versus shares, there are more variables. And these are kind of the variables that I'm going over versus trading shares. You're not as worried about the price. You're not as worried. I do worry about the spread in some tickers, but I'm not as worried about the spread. Uh, I'm not worried about open interest. Open interest doesn't really even exist for shares. Uh, Expiration dates don't exist. So there's way less to think about when you're trading shares of things, but when you're trading options, there's all of these variables that are going to kind of come into play. I guess the last one, and I kind of gave you this, um, is making sure, so I'm going to say, just making sure when you're trading options that the delta is like over 50 cents. And that's why I usually like to trade things at the money or more in the money. the higher the delta, the higher the probability that this is going to stay in the money and that the trade's going to be more effective, and it's going to move uh, more one-to-one with the stock price as you get deeper into the money. So try not to trade these things down here out of the money, outside of the shaded area, especially the further you get down. Yes, they are extremely cheap, but they are extremely cheap for a reason. They're cheap because there's an extremely low probability that uh, that you're going to actually end up making money off buying these options down here. So be careful selling anything out of them, or buying anything out of the money. Um, and with that said, gents, we're right at like 9 o'clock. That was about an hour. Any questions, concerns, any issues, things you want to talk about in terms of platform?
Now, thanks again for a good meeting. I think you've given us clear signs of what to look out, so that way we make wise trades as opposed to losing,
Yep.
especially on the third Friday, and then also the end of the month. So that does make sense, and also with the trading. So,
And
good meeting, man.
yep. And you got any questions?
Not at the moment. There were a couple times I wanted to rewind and I realized that we were live, so I couldn't. So yeah, man, I usually check them out on Sunday and then I check them out again during the week. So I'll let you know.
Okay.
But at the moment, no.
Yeah.
Yeah, man.
All right. Yeah. I just wanted to give y'all some more.
Always.
Wanted to give y'all some more in-depth stuff on options, like, because I feel like everyone always, like, on these YouTube channels, on these, like, they'll show you a strategy, but they won't show you how to execute the damn trade, you know? So they're like, buy this strike at 3:30, and you're like, but how do I buy it? Well, how did you determine to use that strike or that expiration date versus another one, and why? You know, and I feel like a lot of that stuff is lost when people are going on different strategies, like the execution part. You could have a strategy, you could think something's going up, but if you don't know how to trade it and execute it within 5 to 15 seconds, like, it could be gone, or you could hit the wrong button, or you're trading the wrong option. Like, if you traded the option that wasn't liquid, when if you would have went up one more strike price, it would have been a lot easier for you to get in and out of that trade. That's a little small tweak in your process that can make you or lose you a lot of money, you know. So yeah, execution, I think, is everything. So I think that's a lot of what I want to focus on in this channel, is more of execution rather than strategies themselves, because I don't feel like most people really focus on, like, getting in and out of a trade quickly, and then why, you know, why are you buying this instrument versus another one. So yeah, I'm gonna keep these coming. But yeah, till next Sunday, we'll be back next Sunday at 8 a.m. Hopefully I get my live stream up by then, but I think I'm gonna use a different software. But until then, y'all have a good one.
Hey, you too, man.
Yeah.
Take care.
All right, fellas, have a good one.
All right, peace.
All right.